Great. So this is last year's final examination, I believe. And I think it was an assignment for the current year, I think. So that's what we're going to be looking at today. So important instructions, all amounts exclude VAT unless specifically stated otherwise, okay? So all amounts exclude VAT. The VAT rate changed from 14% to 15% on the 1st of April. So you just take note of that in your, in your questions. All persons mentioned are residents of the Republic of South Africa unless stated otherwise. So that means all people in this question will be taxed on worldwide receipts and accruals. And SARS, so SARS stands for South African Revenue Services. All right. So the paper consists of 4 questions. All questions must be answered, obviously. Each question must be commenced on a new separate page. All workings, where applicable, must be shown. So yes, guys, workings are very important. I feel like sometimes even if your final answer is not correct, you have to at least know the principles, and you will be given marks for the principles, for like applying the correct principles, okay? So yes, you have to show your workings, and you also have to be able to substantiate why your calculations are, are like that. And so we're going to be looking at company tax and CGT. There's going to be a discussion of tax consequences. There's a bit of employees tax, net normal tax, provisional tax, as well as trust and estate duty. So that's what we're going to be looking at today. So question 1, Baby Bob Pty Ltd. So you're not dealing with a natural person, that's a company. It manufactures baby prams and distributes them across Southern Africa. The company's manufacturing process has been approved by SARS as a qualifying process of manufacture. So what does this mean? Is there anyone that wants to tell us what this means? What does this mean? Anyone?
Section 12C applies.
Correct. So the allowances that we're going to claim on, any manufacturing items here will be the Section 12C. So they go on to tell us that the company is not a small business corporation as defined in the Income Tax Act. So we're not going to use Section 12 capital E, all right? So the company is registered as a Category A VAT vendor. Is there anyone that wants to tell us what that means? It may be irrelevant for this question, but is there anyone that wants to tell us what that means? Okay, so the company will, when they say the company is registered as a Category A VAT vendor, they mean that they pay VAT every 2 months. Okay, so that's what they mean. And then they go on to tell you that they make only taxable supplies and all transactions are conducted with registered VAT vendors. Okay, so then they go on to tell us that unless specifically stated otherwise, where necessary, BB obtain valid tax invoices and the required documentation for all its transactions. So again, this may be irrelevant for your question, but when they say that, they're essentially saying that BB or Baby Bob Pty Ltd has valid tax invoices. You can't claim input tax without a valid tax invoice. So that's essentially what they're saying. Then the company's financial year ends on the last day of January. So this is very important because you want to make sure that everything falls within this period, within the correct year of assessment. So the first thing you want to do when you see the last day of the year of assessment, you want to ask yourself, when did my year of assessment start? So if it ended on the 31st of Jan 2021, when did it start? that 2020. Am I right?
Yeah.
Yep.
Yeah.
Yes.
Yeah. So everything has to fall within this period. You have to, just take note of that. So they go on to tell us that the company carried forward an assessed capital loss of 20,000 Rand from the previous year of assessment. What do we do with assessed losses? Any idea what we do with assessed capital losses?
Aren't they carried forward?
Yeah. So yeah, they're telling you that it was carried forward from 2020, but now that we're in 2021, what do we do with it?
If we make taxable income or like at the end, then we must deduct it.
Yeah, exactly. So in a nutshell, what you're saying is that assessed capital losses will reduce your current year liability. Is that what you're saying?
Yes. Yes.
All right. Cool. So BB elected not to utilize Section 11O deduction. I believe yesterday, on Friday evening, we spoke about Section 11O deduction. What is it, and how do you get to this deduction? Anyone?
Isn't it like the scrapping allowance?
Yeah.
So if you dispose like of an asset or something,
Mhm.
and you make like a loss on it, like the tax equivalent of that is a scrapping allowance.
Yeah.
And it's deductible usually.
Yeah. So let's say we have a disposal. How do we know if we have a scrapping allowance? Like in terms of the actual calculation, how do we know? So the same calculation that you do for a recoupment, yes?
No, you can continue.
Okay, so the same calculation that you do for your recoupment, which is, remember we said recoupment is the lower of cost and selling price less the tax value, right? That's how you get a recoupment, okay? So when you do that recoupment calculation and you get a negative figure, that's the scrapping allowance, and that's the Section 11O deduction. So this question is saying, BB elected not to utilize the Section 11O deduction. So essentially they're saying, when you calculate your recoupment and you get a negative figure, you're not going to deduct that as, in terms of the provisions of Section 11O. So if they're saying the company elected not to use that scrapping allowance, how do they make up for the fact that they can't claim a Section 11O? So they treat it as a capital loss. So when you have a scrapping allowance, then they treat it as a capital loss in the event that they have elected not to utilize this deduction. Are you guys following?
Yeah, okay.
All right. So the accountant of BB provided you with the following information for the 2021 year of assessment. So, and the sales. Okay, before we read, we have to go find out what's required. So we are required to calculate the normal tax liability of Baby Bob Pty Ltd for the 2021 year of assessment, and clearly indicate and provide a reason where an amount is not allowed as a deduction. So you have to substantiate your normal tax liability calculations. So first of all, we have sales. So today, guys, can you just volunteer? Can you just take us through the paper? Can we take each other through the paper and correct each other along the way? What do we do with sales? Is it revenue? Is it capital in nature? What's going on with the sales? Anyone? So the sales will constitute gross income, okay? So the sales will constitute gross income. And if you want to substantiate, if you want to give a little reason there as to why you are including the amount of 4 million, you just go on to say this is gross income, all right? And then we've got point number 2, the company provided you with the following information in connection with the trading stock on hand. So we've got two columns. We've got trading stock on the 1st of February, and we've got trading stock. I believe this is the last day. This is like the closing. So we've got opening balances and we've got closing balances. Okay. So any idea how we treat trading stock? Are you there, guys?
Yes. I think it is at the lower of cost and what is it? The lower of something in oh yeah, cost and market value.
Mm-hmm.
Yeah, so
for the open, so we agree that these are the opening balances and these are the closing balances. Okay.
yes.
Yeah. And then from these opening balances and closing balances now, we then, okay, so let's start with the opening balances. So what do you do with opening balance? You deduct it in terms of section 22, subsection 2. So it's 22, open bracket 2. So that's the section that provides for a deduction of trading stock, okay? So you take out the opening and then you add back the closing. So now we've got two balances here. We've got the cost prices and the market values. So for your opening balance, you're just going to add the completed products, the raw materials, as well as the packing materials. So you'll get a total of 659,855. So that will be the amount that you deduct. That's your opening balance. You deduct it. Okay. So we come
you would
now.
only take, sorry.
Mm-hmm.
So you would only take the cost price for the opening balance?
Because it's looking at the two, it's lower.
Okay, so you take the lower of.
Yeah, it's not always like the cost. Yeah, you take the lower.
Okay.
And then we come and we look at the closing balances. So we've got let's see. Yeah, so you've got, if you look at here, the lower of the two is the market value. So that's your starting point. This is the closing balance now. So your market value, the lower of the cost and market value is the market value. So you select the market value. And the lower of the two when it comes to the raw materials is the cost price. So you add the cost price. And the lower of the two when it comes to the packing material is the cost price. So you select the cost price. Okay. So that figure, so these are our balances, 440,000 Rand. This is the closing stock. And so these are the balances that we're going to work with, the amounts that we're going to work with for closing stock. We've got 440, 56,000, and 43,888. So the amount that you get there, then that would constitute your closing stock. And what do you do with closing stock? You add it, because you take out opening stock and then you add back closing stock. Okay.
Okay, so we so what we supposed to do is to take the lower of each and every of the individual amount, like
exactly.
Okay.
Yeah, so you take the lower. Okay. Yeah. So moving on, point number 3. Trading stock purchased from South African suppliers for the year of assessment amounted to 780,900. Okay, 780,000 Rand. Okay, so the commissioner has approved the decrease in the market value below the cost price for the completed product. So you've got trading stock purchased. So what do you do with trading stock that has been purchased during the current year of assessment?
Sorry, Matima.
Yes.
Can we ask questions like?
Yeah, it's okay. It's okay. Yeah.
Yes. For closing trading stock, right? Isn't the market value irrelevant when we determine trading stock? Like, I'm trying to think. Was this thing? Let me see. You know that VW case, right?
The what?
Like the market value is like the net realizable value, right? Or am I getting things confused?
Mm, I'm not sure. I don't know.
Okay, no, it's fine. We'll talk later.
Okay, that's fine. So, so yeah, my question was, what do we do with trading stock that has been purchased in the current year of assessment? It's an expenditure incurred. Anyone?
Purchases should be added back because of section 11A. No?
Added back or deducted? Trading stock, like purchases, you have to ask yourself, remember, in order for you to deduct something in terms of section 11A, you have to ask yourself, is this an expenditure incurred? I mean, is this an expenditure actually incurred during the current year in the production of income? And is it capital in nature? So is trading stock capital in nature? No. So it's deductible in terms of section 11A. Okay. So yeah, this should be your takeaway from trading stock, guys. Opening stock, you deduct. Closing stock, you add it back. And any purchases during the current year of assessment, you deduct in terms of section 11A. However, when it comes to valuing your opening balances and your opening stock and your closing stock, you look for the lower of the cost and the market value. So that should be your takeaway from trading stock, okay? So moving on, we've got salaries. And the question says that salaries amounted to 680,000 Rand, 680 and 800. These salaries were paid during the 2021 year of assessment. And in addition, the company also contributed a monthly amount of 26,000 Rand. And this is to a local registered pension fund in respect of all the employees to assist them in providing for their retirement during the entire year of assessment. So in addition to the salaries, the company also paid 26,000 Rand, and this was per month. And this was in respect of a retirement for their employees. And then BB also paid an annuity of 50,000 Rand each to Jakes and Abigail. So this 50,000 Rand was paid to two people, to Jakes and Abigail Dlamini, the children of a retired employee on the grounds of old age. Okay. So we have to talk about each of these figures. How do we treat the salaries? How do we treat the amount that the company paid for the retirement of the employees, and how do we treat the annuity? Anyone?
I would say that the salaries, that's kind of the easiest one, where you just apply section 11A.
Yeah.
Yeah, so you deduct that.
Yeah.
I'm not too sure about the others.
Okay. So the 680, yes, it's deductible in terms of section 11A. And then the company also contributed a monthly amount of 26,000 Rand in respect of a local registered pension fund. Okay. So this is also deductible. This amount is also deductible. Can I just find my income tax act? Do you guys want me to just tell you the section, or do you guys want me to actually open the income tax act and show it to you? What do you guys prefer?
I
I
prefer
have my
it- okay.
legislation with me, so you can just mention the section, I guess.
Yeah,
Okay.
I agree.
Okay. So perhaps you can then just read for us what the legislation is saying. Can you check section 11L? Small letter L.
Please repeat the section.
11 small letter L.
Thanks.
I think it's got to do with employee related expenses. So this is an employee related expense and it's deductible in terms of section 11L, small letter L, okay?
Okay, so it says general deductions, blah, blah, blah of section 11, right?
Mm.
Then section 11L says any amount contributed by a person that is an employer during the year of assessment for the benefit of or on behalf of any employee or former employee of the employer for any dependent or nominee of a deceased employee or former employee of that employer to any pension fund, provident fund, or retirement annuity fund in terms of the rules of that fund.
Yeah, so that's what section, so this amount, the 26,000 Rand, remember it's a monthly amount, so we have to multiply it by 12, okay? So then the amount of 26,000, let me just calculate, it's 26,000 times 12. Yeah, 312,000 Rand. So that's the amount that's deductible in terms of section 11L, okay? And then the annuity, can you read section 11, small letter M? I think it's M, small letter M. Are you there?
Oh, I'm reading and my mic is off.
Mm-hmm.
So section 11, small letter M says, any amount paid by way of annuity during the year of assessment by any taxpayer to a former employee who has retired from the taxpayer's employ on grounds of old age, ill health, or infirmity, or to a person who was for a period of at least 5 years a partner in an undertaking carried on by the taxpayer and who retired from the partnership in respect of the undertaking on grounds of old age, ill health, or infirmity,
Yeah,
provided that the amount paid to such person is reasonable.
thank you. So this annuity was paid on the grounds of old age. It was paid to 2 people. So that means we have 50,000 Rand times 2 people, and it's deductible in terms of section 11, small letter M. All right. Any questions there? Can we move on? All right. So next up we have the doubtful debt allowance claimed and approved by SARS in the 2020 year of assessment was 29,000 Rand. So in the previous session, we spoke about provision for doubtful debt in terms of section 11J. So we are given the prior year provision. And then the question goes on to say that the accountant provided you with the list of debtors as at 31. So this is the end of the year of assessment. So the total of people that were owing the company the amount was 322,680,000 Rand, okay? And the company adopted IFRS 9 for financial reporting purposes, and the total doubtful debt amount relates to the lifetime of expected credit losses, okay? So remember, when it comes to allowance for doubtful debt, yes, it is deductible in terms of section 11J, but it's not like bad debts where you just deduct the full amount. So section 11J has conditions, and you have to look at whether the company has adopted IFRS 9 or whether the company has not adopted IFRS 9, because then the deduction in terms of section 11J would be determined by whether or not the company has adopted IFRS 9. So may you please read for us section 11J and look for the part where it says where the company has adopted IFRS 9. Can you just read it for us?
So the part says that debt had become bad of an equal amount equal to, if IFRS 9 is applied, 40% of the aggregate of the loss allowance measured at an amount equal to the lifetime expected credit loss as contemplated in IFRS 9. And in respect of debt, the amounts included 25% of the loss allowance.
Yeah. So the first thing you do with an amount for provision for doubtful debt is, if you have the prior period amount for doubtful debt that was allowed by SARS, you add it back. So that's the first thing we do. So we're going to add the 29,000 Rand. And then now we move on to the current year debt. And then you ask yourself, how much of this 322,680 is deductible in terms of section 11J? So when the company has adopted IFRS 9, section 11J says you can only allow as a deduction 40% of the total, 40% of the total doubtful debtors, right? So 40, let's see, so it's 322,680 times 40%, that should be 129,000. Yeah, it should be 129,072. So that's how we deal with the provision for doubtful debt. You have to look at whether or not the company is applying or adopting IFRS 9, and also you also have to deal with the prior period doubtful debt allowance that has been approved by SARS. So you add it back, and yeah.
So the adding back of the 29,000 is only applicable if the company uses IFRS 9.
No.
It doesn't matter.
Yeah. So whether or not the company, yeah, doesn't matter. You always add back the prior period doubtful debt.
Matima?
Yes.
So when the company uses IFRS 9, then we don't multiply by 40% and then also multiply again by 25%, like when it's not using IFRS. So is that the difference between the two?
No, remember the 40% and the 25%, it's dependent on how long this debt, how long have these people been owing us. So if you read section 11J, it shows you that you apply 40% when the debtors have been owing for more than 120 days. So like here, we are told that the total doubtful debt amount, it relates to the lifetime expected credit losses. So it's not people that owe us for like less than 60 days. So that's why we're using 40%. So the percentage, it depends on how long these people have been owing us. Yeah. Are you answered?
Okay. So this lifetime expected credit
over,
loss is
it's over 120 days.
Oh, okay. Thank you.
It's over 120 days, yes.
Okay, thank you.
Yeah.
Can I ask, Matima, since we said here, right, that IFRS 9 is applied, right?
Yeah.
Don't we use both the 25% and the 40%? But like you take 25%, I think, of the credit loss that is due like in 12 months, plus like 40% of the credit loss. Like, don't you add the two together when IFRS 9 is applied?
I think the question will normally like break it down to you. Well, most of the questions that I've seen, they usually tell, like, if they want you to use both percentages, they'll tell you that this group of debtors have been owing for 60 days, and this group of debtors have been owing for more than 120 days. So then that's when you will then apply 25% on the other group, and then 40% on the other group.
So since they just told us of the lifetime expected credit loss here, we just use the 40%.
Yes.
Okay.
Thank
you.
Yeah. So next up, BB incurred the following expenditure during the current year of assessment. So this expenditure was for electricity and packaging. So the first thing that's standing out for me here is that this was expenditure incurred in the production of income, right? So now let's look at these dates. These dates are very crucial. So number one, the company paid electricity for the period 1 October 2020 to 30 September 2021. So I'm just gonna go back to, so it's 96,000 rand. So I'm just gonna go back to the note I made on the year of assessment. So my year of assessment starts on the 1st of February 2020 and it ends on the 31st of January 2021. So let's go back. So this payment was made during the year of assessment. However, it was a prepaid expenditure because a certain portion of this 96,000 rand relates to a period that's way after the year of assessment. So this period is way after 31 Jan 2021. Okay. So any idea on how we deal with prepaid expenses?
I don't know,
Okay.
don't we
Mm-hmm.
like deduct part of the expense that's like that we've used this year, I think. I don't know.
Yeah, you are right. But is there something that you feel like you're missing? Because there's something that you're missing. How do you get to the conclusion that I must deduct a certain portion? Because there's conditions, there's factors that you look at, and what are those factors?
So you deduct the one that applies for the current year, and then the prepaid one, there's certain rules that apply. So either if it's, I think, more than 6 months,
Yeah.
and more than 100,000.
Yeah, thank you. So that's the criteria that I was looking for. So you don't always just automatically deduct a certain portion. You first have to look, is this amount less than 100,000 rand? And if it is, then perhaps you can deduct the full amount. And number two, is this amount for like a period, is this amount for a period less than 6 months? So now we have to count. Okay. So now we have to establish from the 1st of Jan, from the 31st of Jan 2021 until the 30th of September, is that period less than 6 months?
From 1st October to 30 September?
Mm.
No, it's more than 6 months.
More than 6 months. So that means then we can't deduct the full 96,000 rand. So we must only deduct the portion which relates to the current year of assessment.
Can I please just ask, and sorry
Yeah.
to put you on the spot like this, but do you know the section where I can get this criteria?
Yeah, it's section 23, capital letter H.
Okay, thank you.
Yeah.
Matema.
Yes, I can hear you.
Okay. So with the months, okay. So we have to calculate the months given that we are given and see if those months are more than 6 months. We don't necessarily look from the year end to whenever when it is prepaid.
Do you see the little note that I've made here? Do you want me to zoom it in?
Yeah.
Can you see it clearly?
Yeah,
So
I can see it.
This little comment that I've put here, I am counting the period from the year end.
Okay.
Until the 30th of September. I'm not counting.
Yeah, okay.
I'm counting from the year end. And had this period been less than 6 months, then I was going to be able to deduct the full 96,000 rand in the current year of assessment.
Okay.
But when you count February, March, April, May, June, July, August, September, that's like 8 months. So I can't deduct the full 96,000 rand. So basically, the logic behind prepaid expenditure is that, number one, the first thing you ask yourself, is this expense generally deductible in terms of Section 11A? Yes, it's deductible because it was in the production of income. However, when it's a prepaid expenditure, not the full amount is always deductible. There are limitations placed on the amount that you can deduct, and the limitations are in terms of Section 23H. So the limitations are, if the amount is less than 100,000 rand, you can deduct the full amount, number one. The second criteria is, if the amount is for a period starting from the 31st of January 2021. If it's for a period less than 6 months, then you can deduct the full amount. When we look at this amount, it's 96,000 rand. So we move on to the second criteria, which is the 6-month criteria. When you count from the 31st of Jan 2021 to 30 September 2021, that's 8 months. So that means Section 20, so that means we can't then deduct the full amount. We can only deduct the portion relating to the current year of assessment. And that portion, yes?
Oh, yes, you can carry on.
Yeah, and that portion relating to the current year of assessment, you then start counting from October. You've got October 2020, November, December, and January. So that's 4 months. So that's the amount that you can deduct in terms of Section 11A.
Okay, so in other words, both requirements need to be met.
Exactly.
Okay, so if both requirements are met, then do we deduct the full amount?
Yes.
Okay.
Yeah. So here, the 100,000 criteria requirement is met because the amount is less than 100,000. However, the 6-month criteria is not met.
Oh, that's why we only are portioning now.
Yeah.
Okay.
So then that means the deductible amount will be 96,000 rand times 4 over 12.
All right, thanks.
So we look at the packaging machine rental. It's for the period 1 December 2020 until the 31st of August 2021. So I'm going to do the same thing here. I'm going to make a little note and just to count, to say, okay, from the 1st of December 2020 until 31 Aug 2021, how many months? No, it's supposed to be from the 31st of Jan until the 31st of August 2021. So it's February, March, April, May, June, July, August. So that's 7 months already. The 6-month criteria is not satisfied. And then when you look at the amount also, it's more than 100,000 rand. So the 100,000 criteria is also not satisfied. So then we apportion, we deduct the amount relating to the current period. Are you guys happy there?
So how exactly do we apportion it? Is it the 3, 4, 5,000, and then I'm not sure what to do after, how to apportion.
So okay, so it's 3, 4, 5. Let me just calculate. Yeah, it's supposed to be, wait. Okay, all right. So let's start by counting the number of months from the 1st of December until the 31st of August. So it's December, January, February, March, April, May, June, July, August. That's 9 months. So they were paying for a 9-month period. So that means that when we apportion, we will have 345 times 2 over 9 months. And the 2 is December and January. And then the 9 is the total period that they were paying for. So in the first one, for the electricity, we said over 12, and that's because they were paying for the whole year. Are you guys following?
We said for over 12.
Because they were paying, if you calculate the number of months from 1 October to 30 September 2021, that's 12 months. So that's why we said over 12. And here we're going to say 2 months, which is December and January, over 9. Yeah, over 9, and that should give you 76,667, I believe.
I think I'll have to talk with you afterwards. I'm still quite confused.
No problem. No problem. But is there anyone else that's confused here? That's still confused, so that we go over it. Are you all good? Okay, so I'll move on. So point number 7, you received the following information in respect of the assets held by the company. BB purchased a new manufacturing machine for 715. And on the 31st of, so this was purchased on the 31st of August, 2020. And it was brought into use in the process of manufacture on the same date. Okay. Okay. So how do we treat this purchase? What do we do with this purchase? Any idea? Any attempt? Remember, guys, it's better to attempt and get it wrong in this session because tomorrow you're writing your exam. So it's better to attempt and get it wrong and get corrected.
I think we need to multiply it by 40% because it's new.
Where are you getting the 40% from?
From the rules where if the manufacturing asset is new, then it's 40% for the first year, then 20% for the rest of the 3 years.
And which section is this?
12 capital C.
Yeah. Thank you. That's what I wanted to hear. So yes, because remember, when you put your calculation there, you also have to write the section to say this is 40% in terms of section 12 capital C. Is this section apportioned?
No.
No apportionment, right? So that's it for this machine.
So I wanted to ask you, if you don't put your reference basically to section 12 capital C, do you lose the mark?
I don't think you lose a mark, but I think you'd get half a mark. Like I feel like if I were the marker and you're just putting an amount and you're not telling me where you're getting it, I wouldn't give you full marks. So you have to write the section just to make sure you get the full mark there. So next up we have, let's see, there's a delivery vehicle that was purchased for an amount of 294,400. Okay. And this amount was including VAT. It was purchased on the 1st of April 2019. So this delivery vehicle was sold to a non-connected person for an amount of 120,000 rand at arm's length. So this was, this was a fair price, basically. So it was sold during the current year of assessment. So is there anyone who wants to take us through this delivery vehicle? How do we calculate it? What's the starting point? Anyone?
Okay, so the first thing would be to take the 294,400 and exclude the VAT.
Yeah,
And then that would be the cost of the item.
correct.
And after that, we calculate the wear and tear on the item, which would give us our tax base, and then subtract that from the selling price,
Yeah.
which is 120.
Yeah, correct. So yeah, that's the starting point. You have to take out the VAT, but very important, you have to be careful of the date of purchase, because if this was purchased before the before the VAT changing from 14% to 15%, then the VAT that you take out would be 14%. So you have to take note of that date. So after calculating the cost less the VAT, then you calculate your tax value. And you're going to calculate your tax value by using the wear and tear allowances. Remember, wear and tear is apportioned. Okay. So that means we're going to calculate wear and tear for the first year of assessment, which was from, let's calculate that. So if it was purchased on the 1st of April, 2019, and our year of assessment ends on the 31st of Jan, 20, so this will be 2020. How many months is that?
Um, 10 months.
Okay. So first we have 294,400 times 100 over 115. So that gives us a cost less VAT, right? And that cost will be
256.
That cost will be 256, right? So we're going to calculate wear and tear using this amount. And in terms of the binding general ruling, the write-off period for a delivery vehicle is 4 years. And you said it's 10 months. So you multiply then by 10 months over 12. So that's the first allowance. And then you do the same now for until the date of sale. It was disposed on the 30th of September 2020. How many months is that? Can you guys see this little note that I'm making here? And is it making sense to you guys?
Yes, this.
Is it 8 months?
Yeah. So that's how you're going to calculate your total wear and tear. And so you're going to take that out from the cost, and then you'll be left with the tax value. That's how you get your tax value. So now that you have your tax value, you calculate whether or not there was a recoupment. All right. So how do we calculate the recoupment? Anyone?
Mhm.
Please open your note.
Okay.
Okay, so I got the scrapping allowance of 40,000.
Okay. So can you please take us through your calculation?
Okay, so the original cost we worked at was 256,000.
Mm-hmm.
And then I subtracted my allowances, which is like you have on the screen there, 53,000 and 42,000.
Mm-hmm.
And then I'm left with a tax base of 160,000.
Mm-hmm.
And then I subtract that from my selling price, which is 120,000.
Yeah. Okay.
And I'm left with a negative 40.
All right. So that's correct. Thank you. So the easiest way for me to remember the calculation of recoupment or scrapping allowance is the lower of cost and selling price. And in this case, the lower of the two is the 120. So it's the lower of cost and selling price less tax value. So the lower of the two is 120 in this case. And then the tax value was how much was the tax value again?
160.
160. So that's how you get the negative, that's how you get the negative 40. So that's a scrapping allowance, okay? So, however, the question told us at the beginning that this company has elected not to, not to use their scrapping allowances, not to deduct scrapping allowances. So what that means is that you're not going to have a deduction in terms of Section 11O, but when you have, so you're going to use it as a capital loss, basically. So yeah, so you take the same amount and you use it as a capital loss. That's essentially what they mean. And then so finally there was a disposal because, well, this delivery vehicle was sold, so now we have to calculate the CGT. So basically when you don't deduct the scrapping allowance, you use this amount in your calculation of CGT as a capital loss. Are you guys following? So let's calculate capital gains tax, the taxable capital gains, taking into account the scrapping loss that we've just calculated. Are you guys calculating the CGT? Or are you attempting to calculate the CGT?
Sorry, my connection is really bad. Do you mean we should calculate like the net gain or
Yes, that's
assessed loss?
remember when you calculate CGT, before you do the whole 80% and all of that, you calculate like your net capital gains and losses. So I'm
Yeah.
saying when you have a scrapping allowance, you're not going to deduct it in terms of Section 11, or when the company elects not to do that, right? So you're just going to use it as a capital loss in your
In the
CGT
same year.
calculation. Yeah, in the same
Okay.
year, for CGT, for the same asset CGT calculation.
Okay.
So when we calculate CGT, we've got, what do we have? We have proceeds, right? Less recoupment, but there was no recoupment because we got a negative figure. We got a scrapping allowance instead. So there was no recoupment. So that means our recoupment is 0. And then our proceeds remain 120,000 Rand. Then we have the base cost. Remember, the base cost is the amount exclusive of VAT, which was 256. So we have the 256 less the total allowances that we calculated these allowances that we calculated. Yeah, if you add these total allowances, that should give you 96,000 Rand. So you take out these total allowances from your base cost of 256. And I get 160,000 Rand. So that's the base cost that I have.
So the base cost is the same as the tax base?
Wait, let me just...
Or do you have to show it? Or do you have to show it separately?
What do you mean? You mean, can you...
You see, when we did the scrapping allowance calculation, for the first step, we worked out the tax base, and then we said it's the original cost, which is 256, minus all the allowances up to the point of being sold, which is 96. That gave us 160,000. And then now by the capital gains tax, we're saying less base cost, which is also 160,000.
Yeah, you have to show it separately because you still get a you still get a mark. Yeah, so you still have to show it. Yeah, so we've got the capital gain of 120, and we've got we've got a base cost of 160, and that gives us the capital loss. Okay, so we've got the capital loss, and at the beginning of the question, I believe we were given assessed losses. Let me just check. Assessed capital loss. Yeah, we were given an assessed capital loss of 20,000 Rand. So when you take the 40,000 capital loss that you have, and you also take this 20,000 assessed capital loss, you get a total of 60,000 capital losses to be carried forward to the next year of assessment. So that means there's no CGT, there's no capital gains in the current year of assessment. So the scrapping allowance that I was telling you guys about, the same 40,000, if you do your proceeds less base cost calculation, that's the 40,000 that you get, the scrapping allowance, right? So that's the capital loss that you get to carry forward to the next year of assessment. And then that's it. There's no CGT for this delivery vehicle. Any questions, guys?
So what did you say we do with the assessed loss?
So there's assessed losses and there's assessed capital loss. Number one, I don't want you to mix the two. And here we've got an assessed capital loss. So that means this is from the previous year of assessment. So when we calculate CGT in the current year of assessment, we will take this 20,000 Rand, like we will deduct it when we calculate CGT because it's an assessed capital loss.
Okay, so we deducted from this 40,000.
And that will give you a negative 60,000 Rand, which you carry forward to the next year, and you do the same in the next year of assessment. When you calculate CGT, you will take out minus 60,000 Rand. You get it?
Oh, okay.
Yeah. So lastly, there was furniture and fittings with a cost price of 36,000 Rand. and they were purchased during the current year of assessment. So we have to calculate wear and tear, and the apportionment will be from, okay, let's see. This was purchased on the 1st of July. So we have to calculate the number of months from 1 July 2020 to 31 Jan 2021. And that's July, August, September, October, November, December, January. So that's 7 months, I believe. So the wear and tear calculation should be, we've been given the write-off period of 6 years for furniture and fittings, times 6, sorry, divided by 6. And we said it's 7 months. Yeah, that should be your wear and tear calculation. And that should be your wear and tear deduction for the current year of assessment. So are you guys happy there?
Yeah, I'm okay.
Yeah, I'm good.
Yeah, so that's it for this question. And then the question said calculate normal tax liability. So you just add up, oh, before that, there's something else.
Number 8.
Yes. On the 1st of January 2021, BB donated 145,000 Rand in cash. And this was donated to a registered public benefit organization, but it did not receive a valid Section 18A receipt. Okay. So when a company, like if the company is able to prove that they made a donation to a registered PBO and they have a valid Section 18A receipt, they get to deduct this amount, but however, it's limited to 10% of taxable income. So this is in terms of Section 18A. Yeah. So, but now the question is saying these people could not prove they didn't have a valid Section 18A receipt. So I don't think they are able to deduct this amount from their taxable income. So what you then do is you just add up everything that we've been calculating, and then you get your taxable income. And because we are dealing with a company, then you multiply by 28%. Remember, if you're dealing with a small business corporation, it will be taxed on its own. It's got its own tax table. So, but this time around, it's not a small business corporation. So for normal tax liability, we'll just multiply by 28% of the taxable income, and that's it. If there's provisional tax, you take that out to get your normal tax liability. But here, there's provisional tax. So that's it for question 1, guys. Any questions? Are you all good?
Yeah, I
Okay.
think I'm fine.
So question 2, so this is a discussion question, and it says Bear Grylls Pty Ltd is a company that mainly sells cattle feed to farmers and operates from Welkom in the Free State. The company is effectively managed in the Republic of South Africa. The company also has a few specialists that assist the farmers with cost-effective improvements for their pastures for cattle. This is commercial knowledge. Know-how payment sold to farmers has proven to be very profitable. Okay. So the commercial knowledge has proven to be profitable for the company. So the company's financial year ends on the 31st of March 2021. Remember, whenever you see a financial year, you just make a little note to say, okay, if it ended on the 31st of March 2021, so it started on the 1st of March. So sorry, if it ended on the 31st of March, so it started on the 1st of April. So I like making a little note there just to put things into perspective. So it's also a registered VAT vendor making only taxable supplies. So on the 1st of July 2020 is this during the current year of assessment? Yes, it's during the current year of assessment. So Bear Grylls paid 250,000 Rand to a pasture specialist to entice him to accept employment with the company from the 1st of August 2020. So this was not a salary. It was just an amount paid to this person to entice him to accept the offer of employment. And the contract and salaries package will be negotiated at a later stage. On the 16th of August 2020, Bear Grylls received an amount of 75,000 Rand in cash from a big commercial farmer from the Free State for services rendered by the company's newly hired pasture specialist. So this was for services rendered. So, okay. So you are required to discuss with supported relevant legislation and relevant case law principles and case law names, whether the amount of 250,000 Rand paid to Bear Grylls Pty Ltd will qualify as a deduction from the company's taxable income, and whether the amount of 75,000 Rand that Bear Grylls Pty Ltd received will be regarded as gross income as defined for the company. So there's two things that you are required to discuss. Number one, the deductibility of the 250,000 Rand to entice this specialist guy to join the company. And number two, you're also required to talk about the amount of 75,000 Rand that the company received. So there's like most of your questions in most of your questions, you'll just get like a gross income discussion question or a general deduction discussion question. But this time around, you seem to get a bit of both. So remember, in the last session, I told you guys, if you want to score marks here, you have to use a lot of case law principles. So your starting point would be breaking down, like for the 250,000 Rand, you have to break down the general deduction formula. So you literally break it down. So you literally write, expenditure incurred, and you explain whether or not there was an expenditure actually incurred in the production of income. You substantiate whether or not this amount was in the production of income and whether or not this amount was capital in nature or not. So you have to break down the general deduction formula. You do the same with the gross income definition. You break it down and you apply every part of it into your question, right? And then you conclude. And then also you have to throw in like a couple of cases in there. Like I said, you don't have to know the entire cases, but just know a couple of cases that you're going to use in your exam, and just know the principle that you're going to use in your exam, okay? So is there anyone that wants to attempt? Can I have two volunteers, one to attempt the 250 discussion and one to attempt the 75,000 Rand discussion?
Can we just discuss it because I have questions, no?
It's okay.
But I don't necessarily have the answers to everything, right?
Yeah.
So I'm not answering, but I'm just putting my 2 cents forward, right?
You're answering, yes.
So for the 250, right? If we analyze it according to the deductions formula, so the first part is expenditure actually incurred.
Yeah.
So Bear Grylls paid out the 250, so it was actually incurred, and they paid out in this year of assessment as well, so it's still in this year of assessment. To entice him to accept employment, this is where now I have a problem of whether it's in the production of income or not, right? Because my thing is, I think also the question just literally has very few information about this, because if this was something that was done or that is like done in the industry, you could conclude by let's say in whatever business they are in, this is common practice. So you could conclude that way that this is a necessary concomitant of trading activities when you are trading in that industry. But otherwise, it just sounds like a bribe.
And it doesn't sound like it's in the production of income. Do you guys agree?
Yes.
Can you guys, like, can everyone please talk to us? Can you at least, you know, send a message in the chat box or something? Can we all talk? Can we all discuss? Can we contribute something? You know, it's easier to remember something in an exam when you've actually had a conversation about it.
Yeah, I agree.
So what do you guys think?
Can you just repeat the question again?
The question is, like, we're talking about the 250. So we're trying to establish whether it was in the production of income. That's what we're trying to establish.
Yeah, I don't think so.
Yeah.
I don't think it because he's also not employed by the company as yet also.
Exactly. So this person is not yet an employee. Yeah. So okay, so your biggest takeaway from this is you have to break down. Do you guys have the memo to this question? Have you seen the memo to this question?
No, I haven't.
Okay.
There's no way to get it.
It's actually there in your group because I just saw it right now in your group. Ne? So I'll send it to you guys. So what they've done is, like, they've done exactly what I'm telling you guys. You break down the general deduction formula definition, and you literally write expenditure actually incurred, and then you go on to say there was a 250,000 rand that was actually incurred to entice someone, right? And in the production of income, and then you think, you write whether or not you think it was in the production of income, and if you don't think it was in the production of income, then you say exactly that. And then you also talk about the non-capital in nature. That's the last part of the general deduction formula. This amount was not capital in nature, but it was not in the production of income, and therefore it is not deductible in terms of section 11A. So that's how you go about your discussion questions. Yeah, that's how you go about it. Also, you can just throw in a couple of cases in there. For example, in Jofe and company, I mentioned this case in the previous session, that there was a company that was, I think it was a construction company or something, and I think a guy died on site. The company tried deducting that as they tried deducting the amount for damages and compensation to the deceased family, and it was held that negligence is not a necessary concomitant of the business operations. So those are some of the things that you can throw into this question to make sure you get your full 20 marks, because guys, there's no, like, 20 marks out of, how much is this paper? Is it out of 100? 20 marks is a lot. Okay, so this is where you need to, like, I don't know if I should use the word monetize. I know it's the wrong word, but yes, get your marks. This is where you're supposed to get your marks. Okay, guys, discussion, get your marks, because there's no calculation there.
Where do you get the case laws? That's
I'll send them to you.
TAX3. Okay.
I'll send them to you. I actually sent them to everyone yesterday. I'll send them to you. Please remind me after the session.
Thanks.
Yeah. Then we move on to the 75,000 rand. You do the same thing. You break down the gross income definition and you apply every bit of it. Total amount in cash or otherwise. You go on to write next to that yes, there was a total amount of 75,000 rand. It was in cash. Yeah, so I'm just looking for the gross income definition. Yeah, so yeah, total amount received by or accrued to, you go on to write the amount was received by Bear Grylls on the 16th of August 2020. During the year of assessment, you mentioned that it was received during the year of assessment, not of a capital nature. This amount was for services rendered, right? Therefore, it will be, if it was for services rendered, it is included in gross income in terms of paragraph C of the gross income definition. So yeah, this is very basic stuff. I think the biggest thing here is you have to apply every bit of the definition into your question and throw a couple of cases. Remember, you don't have to quote the whole case. You can just mention in CIR versus VISA, this case introduced the tree versus fruit principle. Are you guys familiar with that case? Fruit versus tree principle case. Those are some of the cases to throw into this kind of question. Okay. Yeah. So that's it. So the first one is not deductible and the second one is deductible, but you have to substantiate. I mean, it's included in gross income. So guys, I think let's take a 10-minute break or a 15-minute break. And then we'll be back for the last two questions. Is that okay with you guys?
Yeah.
Yeah,
problem.
sure.
So we'll be back. Yes.
Hi,
So is
yes,
it 10 minutes or 15 minutes? I don't know how much time you guys need.
I
10
said
minutes?
10.
10.
Cool.
10,
So
yeah.
let's be back in 10 minutes.
sorry, can I ask a question, just a small question before we leave regards to the questions?
Yeah.
I want to understand with when you are approaching this question, how do you know whether to use the gross income definition approach or the general deduction approach? Because they're similar, but not exactly the same.
Okay. So number one, we have to establish the parties, right? So here we've got Bear Grylls, right? And they are saying Bear Grylls paid. So if you paid something, it's an expense. So you're trying to establish whether or not you can claim a deduction for the expense. So that's how, like when they tell you the company paid something, that's when you use the general deduction formula. And then when they tell you the company received something or the taxpayer received something, then that's when you use the gross income definition. So the key word is received, that's gross income. And then paid, that's general deduction formula.
Okay, thank you so much. That's very clear. Okay.
All right, cool.
Okay.
Welcome back. Are you all ready?
I'm back.
Yes.
All right. So, question 3 is out of 39 marks, and it's a 70-minute question. Okay. And let's read. So it says that Sonke, 65 years old and a widower, is an employee of a large retail company, Homeware. He retired on the 28th of February 2021 after he worked for his employer for 35 years. Okay. Below are the details of Sonke's total income, benefits, expenses, and contributions for the 2021 year of assessment. So remember, before you go into the details, you have to establish what's required. So the required is broken down into 4. Number 1, you're required to calculate the employee's tax that Sonke's employer had to withhold from his remuneration for the month of February 2021. So remember, when you calculate your employee's tax, you have to read the required carefully, whether they are asking for the entire year's employees tax or whether they are asking for employees tax for just 1 month or 2 months. So in this case, the question is asking for employees tax for just the month of February. And also you have to provide reasons for all amounts not used in your calculation. So if you're going to include something, you have to substantiate. And also if you're not going to include something in your calculation, also you have to mention why you're not including that amount in your calculation. Second question is a provisional tax. Yeah, it looks like provisional tax. We will get into it. And then third question, if Sonke did not use his actual taxable income, advise him how to determine the basic amount, okay? And then lastly, normal tax liability on the lump sum only, okay? So let's start with the employees tax. So, all right. So how I normally calculate employees tax is I calculate employees tax for 1 month. Basically, I calculate the amounts that the taxpayer is receiving for 1 month, and I add all those amounts together. I also take out the deductions that is able to deduct in a single month, and so these are income. These are income amounts and expenses that the taxpayer receives consistently every single month. So, for example, I'll just say salary 1 month. If the taxpayer is receiving, if the taxpayer receives contributions from the employer, I'll also include those contributions for the month. And then I calculate the balance of remuneration and multiply it by 12, right? So if you take a look at your memorandum, they've done it quite differently, but they've put in both workings, like the working that I'm talking about, and then they have like their own working there. So I'm just going to obviously talk about what I know best, right? So for the purposes of calculating employees tax, the first amount that's there is a salary. So the question says below are the details of the total income, benefits, expenses, and contributions for the 2021 year of assessment. So these amounts are for like the whole year. These are not monthly amounts that the taxpayer has received. So I've got 624,000 Rand for the entire year. And for the purposes of my employees tax calculation, I would then say 624 divided by 12 to get the monthly amount that the taxpayer gets. And that would be 52,000 Rand. And are we going to include the bursary? Can someone tell me if we're going to include the bursary? Do you guys think we're going to include it in the employees tax calculation? What do we do with this bursary? Let's read. So it says Sonke's employer awarded a bona fide bursary of 30,000 Rand to his granddaughter during February 2021 for the payment of her grade 12 fees. So the question goes on to say that assume that Sonke's remuneration proxy was 575,000 Rand for the 2021 year of assessment, and his granddaughter does not have a disability as defined in terms of section 6B. So what do you guys think we're going to do with this bursary? We're calculating employees tax, and how would you guys treat this bursary for employees tax purposes?
I have no idea. I would actually not include it.
So you would not include it, but you're not exactly sure why you wouldn't include it.
Yeah.
Okay, anyone else?
So Sonke is the person Who is Sonke?
Sonke is the taxpayer.
Okay, I think we would include it because it is from her employer.
Yeah, but remember we're not calculating normal tax, we're calculating employees tax. So when you calculate employees tax, right, you look out the amount that the taxpayer receives consistently, like every single month. An example would be the salary. The bursary he doesn't receive this bursary every single month. He only received the bursary they say during February 2021. So it was a once-off amount. So when your starting point of calculating employees tax is you're looking for amounts that this taxpayer receives consistently every single month. A salary is one of them, an allowance, a travel allowance is one of them, contributions made by the employer on behalf of the employee. Those are monthly amounts that the taxpayer receives consistently. So those are the amounts that you're going to use like as a starting point for calculating your employee's tax. So we're not going to include the bursary because it was a once-off amount. Okay, so am I making sense?
Yes.
Yeah. So next up we have a travel allowance. So let's go read. So a travel allowance would be included because he's receiving this travel allowance like every single month. So it's a fringe benefit that it's a benefit that he receives every single month. So that's why we are including it in the calculation. Okay. So the question says, Sonke's employer paid him a travel allowance for using his own motor vehicle to travel for business purposes. So remember, do not confuse a travel allowance with the right of use of motor vehicle. A travel allowance is when you are using your own car and they give you an allowance to use your own car and, just to be able to be mobile. But a right of use of motor vehicle is when you're using a company car. So the calculations are different, so don't confuse the two. So Sonke always kept a valid and accurate logbook. So he kept an accurate logbook, and his employer is satisfied that he travels 80% for business purposes. Okay. During the 2021 year of assessment, he traveled to 20,000 kilometers for business purposes. So 20,000 was for business purposes, and we're also given the total. So of 24,000 rand. So that means that if 20,000 was for business, if 20,000 kilometers was for business purposes, then that means 4,000 was for private. It was for private use. And then the total kilometers are 24,000 rand. I mean 24,000 kilometers. Yeah. So his vehicle cost him 180,000 rand, including VAT. Very important. And Sonke paid for all the maintenance and the fuel expenses for his vehicle, but did not keep accurate records of the actual travel expenses. So he didn't keep accurate records of the actual travel expenses that he incurred. So that's maintenance and fuel. Yeah, fuel mainly. Yeah. So when you calculate a travel allowance, right? I'm gonna well, obviously from an employee's tax perspective, like I already said, we are looking for the monthly allowance, but yeah. So obviously you have to start off by calculating like for the whole period. So when you calculate your travel allowance, your starting point is, just hold on. Your starting point is the actual allowance received. And the actual allowance received was wait, where is it? It's 60,000 rand. Yeah. So the actual allowance, that's your starting point. That goes into the taxable income of the taxpayer. However, the question told us that the employer is satisfied that he travels 80% for business purposes. So we're going to multiply that 60. Yeah, we're going to multiply that 60,000 Rand by 20%. And is there anyone that can tell us why we're multiplying by 20% and not 80%? When do we multiply by 80% and when do we multiply by 20%? Because we don't always multiply by 80 and we don't always multiply by 20. So
I think you multiply by 80%, right? If the total kilometers for business purposes are less than 80% of the total kilometers traveled.
Please repeat that.
So you multiply by 80%, right? If the business kilometers are less than 70%, 70%, né? Yeah, I think, I don't know. Yeah. Someone help out.
Do you want to?
I'm not sure about this one.
Okay.
We multiply by 20% because 80% of the travels was for business. And we multiply by 80% if the business travels were 20%. So it's vice versa.
Yeah, so it's vice versa. So what I want you guys to like be able to pick up is that you will not always be told that he travels 80% for business purposes. So when you get this question, you then establish business kilometers, 20,000, 20,000 kilometers over the total kilometers. And that's 83%. So it's over 80%, the 80% requirement. So when it's over the 80% requirement, you only include in the taxable income 20% of the allowance and vice versa. So when he travels like more for private purposes, for private purposes, then that's when you multiply by 80. Are you guys following?
Can you identify where that is in the section, or where can we find
it must
to read about it?
It must be section 8. Can someone check it for us? Section 8.
So is it always this 80 and 20 rules, or it could be that maybe the taxpayer traveled 80%, 70% for business purposes, and then you would multiply by 30%?
No, it's always 80-20. Yeah.
Okay.
Can someone please check section 8? I think Roman numeral 1 or Roman numerals 2. Perhaps let me also just check my Income Tax Act. Let me just check. Is anyone finding section 8? Can you guys see my Income Tax Act?
No, we can't.
Oh, okay. Sorry about that. Just confirm if you can see it. So I am busy checking for section 8 because that's a section that talks about travel allowance. Can you guys see it now?
Yeah, yeah, we
Yes.
can.
Yeah. So it says certain amounts to be included in income or taxable income. So they shall be included in taxable income of any person hereinafter referred to as the recipient for any year of assessment, any amount which has been paid or granted during that year by his or her principal as an allowance or advance, excluding any portions or allowance or advance to the extent that the allowance or advance or a portion. Sure, it's so complicated, but yeah, it's for traveling. Wait. So this one, the first subsection is for a right of use of a motor vehicle, as you can see here. And then I think the next one talks about the travel allowance. Let me just check if it explains the 80-20 rule. Okay, so this is okay. Any allowance or advance in respect of transport expenses shall, to the extent to which such allowance or advance has been expended by the recipient on private traveling, including traveling between his or her place of residence and his or her place of employment. Okay. I can't seem to locate the part where they talk about the 80-20 rule. But the allowance itself is in terms of section 8. Yeah, I can't seem to locate the part where they talk about the 80-20 rule, but the allowance of the travel allowance itself is in terms of section 8. I think it's 8(1)(b). So yeah. Can you guys see the question?
No, we can't.
Can you see it now?
Yep.
All right. Yeah, so for employees tax purposes, we're not going to do like we're just going to calculate the actual allowance, right? And the actual allowance is 60,000 Rand times 20%. It's 20% because he has traveled more than 80% for business purposes. Had he traveled only 20% for business purposes, then we were going to multiply by 80%, right? And So for the purposes of the employees tax calculation, we are not going to we are getting to the deemed cost and actual costs section in the next question. But for employees tax, we're just looking for the amounts that this guy receives every single month, right? So we spoke about the salary of let's see, we spoke about the salary of 624 divided by 12, and that's 52,000 rand. We said we're not going to include the bursary. Then we've got the 60,000 rand. So we'll say 60,000 rand for the travel allowance multiplied by 20%, and that's 12,000. So when you divide that 12,000 by 12 months, so the monthly allowance is actually 1,000 rand. So when you add that up, the remuneration then will be 53,000 rand. So that's the remuneration. So we are looking for the balance of remuneration. Okay, so let's read more information. So next up, we've got net rental income. Let's see. But remember, for employees tax purposes, we are looking for remuneration. So this rental income would be included for your normal tax calculation, not for employees tax purposes, right? Because it's not remuneration. His remuneration is what he's receiving from his employer. So, and that would be the salary and the travel allowance. So the rental income we're not going to include for employees tax purposes because he doesn't receive rental income from the employer, right? So
okay.
So then the next thing is there's retirement annuity fund contributions. Let's see. Sonke received a retirement lump sum benefit of 1.6. So remember, when you calculate employees tax, you are looking for the amounts that he receives consistently every single month, right? That's your starting point. So when you look at this retirement annuity fund, he doesn't receive a lump sum every single month, right? So we're going to do a separate calculation of employees tax on this lump sum separately. So we will come back to it. And then what else do we have? Let's see. Then there's retirement annuity fund contributions. Sonke contributed to the approved retirement annuity fund during the entire 2021 year of assessment. The total contributions during the 2021 year of assessment amounted to 100,000 rand. So these are his contributions, total contributions. His employer, Homeware, was not aware of these contributions. And all Sonke's retirement annuity fund contributions up to 21 February 2020 qualified for a tax deduction apart from the retirement annuity fund. He never belonged to any other type of retirement annuity fund. So from an employee's tax purposes, guys, like retirement annuity fund contributions are treated differently for employees tax purposes and for normal tax purposes. Okay, so for employees tax purposes, you're going to remember, retirement fund contributions are deductible. Let's start there. They are deductible in terms of section 11 capital F. However, for employees tax purposes, if the question tells you that the employer was not aware that the taxpayer has been paying something every single month towards his retirement, if the employer is not aware of these contributions, then you're not going to include them in the calculation for employees tax. And I'd like to assume that employees tax is withheld by the employer. It's a calculation that's done by the employer. So if you don't go to your employer and say, listen, I'm making monthly payments towards some retirement fund somewhere, he's not going to know. The employer is the one that calculates employees tax. So that's why you're not going to include that section 11F deduction for total contributions if the employer is not aware. Okay, but if the employer is aware that you've been making contributions towards a retirement fund, then that amount will be included. That deduction will be included in your employee's tax calculation. And assuming that the question was saying that the employer is aware of the contributions, is there anyone that wants to take us through the calculation? Any attempt?
Is it like the normal contribution, like when you calculate the tax liability, where you first have to compare? So you take all your contributions for the year, you compare them to, I think it's the taxable income and the three, let me go to section 11.
Are you all comfortable with section 11 capital F for retirement fund contributions, total contributions?
Yes.
Yeah.
I am.
Okay.
Yeah.
All right. Can go on. So
Yes. So
what do we do?
basically, the total deduction for the year must not exceed 350,000 Rand or 27.5% of the higher of remuneration and taxable income. So you calculate your taxable income, you get 27.5% of it, your remuneration as well, and then compare it. And then, yeah.
Yeah. So that's how you do it, right? But very important for normal tax, from a normal tax perspective, like when the question wants you to calculate taxable income or normal tax, then yes, that's how you do it. But for employees' tax purposes, remember, we are calculating the monthly amounts. We're calculating monthly figures. So you're going to divide that 350 by 12. And that should give you around 29. Yeah, it should give you 29,167. So that means basically what happens is section 11F provides a limitation to how much of these contributions you can deduct. So if the question is telling us that these contributions were made, okay, so in this question, we're not going to do the whole section 11F for retirement, for employees' tax purposes, because the employer was not aware. But if the employer was aware, then we would do a section 11F deduction limited to 350 and 27.5% of remuneration and 27.5% of taxable income. And for employees' tax purposes, the 350 would be divided by 12. But for normal tax calculation, you don't divide the 350 by anything. So are you guys all happy there?
So with the employee tax, you're only dividing the 350 by 12. You're not dividing the other amounts by 12 to see what's the lesser of.
Yes, only the 350.
Okay.
Yeah. And that's if you're doing the calculation the way I do it, where you calculate the monthly amount. Yeah. So after that, we've got a balance. We get your balance of remuneration. You multiply your balance of remuneration by 12, right? And the balance of remuneration is always multiplied by 12. So even if the taxpayer retired during the year of assessment, or the balance of remuneration is always multiplied by 12. And then after getting your balance of remuneration, then you calculate tax using your tax table, right? Your normal tax table, and you take out your primary rebate. Okay, so remember, your primary rebate, it's dependent on the age of the taxpayer. If the taxpayer is under the age of 65, then your primary rebate will be 14,000. It must be 14,958. But now this taxpayer is 65 years old. So not only is he going to get a primary rebate, but he's also going to get a secondary rebate as well. So his total rebates will be 14,958 plus 8,000. I think it's 8,199. So those will be his total rebates. Okay. So are you guys happy there?
Yes.
So let's continue to read. So they go on to say, wait, let's see. Oh yeah, again, he made contributions. There were contributions towards medical aid, right? He contributed 48,000 rand towards a medical aid, and he also paid an extra 3,000 rand for prescription glasses. So this was qualifying medical expenditure. But the question says the employer was not aware that he's a member of a medical aid scheme. So again, if the employer is not aware that you're making contributions somewhere, he's not going to include this in the employee's tax calculation, because like I said, the employer is the one that withholds tax. So if you don't disclose that you're making contributions towards a medical, a medical scheme somewhere, the employer is not going to calculate that, is not going to include that in the employee's tax calculation. So therefore, we're not going to include them. So after the primary rebates, there are no medical, tax credits. Then, so the amount that we get now after taking out the primary rebate, we then divide it by 12 months. We then divide it by 12 months and you get your monthly employees tax. So that's the employees tax for the month of February. So are you guys okay there?
Yeah.
But remember now, there was so there was an amount, wait, just hold on. There were two amounts that we didn't include in the employees tax calculation, and this is because they were variable remuneration. They were not amounts that he receives every single month. I'm just gonna scroll up. And the first one is the bursary. Remember, we said it's variable remuneration, so you don't include it in the first calculation. And the second one is the retirement annuity lump sum benefit. It's 1.6 million. It's also variable. So you do a separate calculation of employees tax withheld on these variable remunerations, right? So your starting point for calculating employees tax on the variable remunerations is the annual equivalent that you would have calculated. So the annual equivalent is just your balance of remuneration times 12. That's your annual equivalent. So you take that annual equivalent, and then let's talk about the bursary. Let's start with the bursary, right? So Sonke's employer awarded a bona fide bursary of 30,000 rand, and this was to his granddaughter for the 2021 February fees, and the granddaughter is in grade 12. And then we also gave him the remuneration proxy of 575. So I believe there's an exemption in terms of section 10.1. It must be 10.1Q. Can anyone check section 10.1Q for us, please? So this was quite a popular exemption that they like testing, also your uniform allowances and all of that. So
section 12.1Q says that any bona fide scholarship or bursary other than a scholarship or bursary contemplated in paragraph Q, cap A, granted to enable or assist a person to study at a recognized educational or research institution, provided that if any such scholarship or bursary has been granted by an employer or an associated institution to an employee or to a relative of such employee, the exemption under this paragraph shall not apply in the case of a scholarship or bursary. It's a very long section. In the case where the bursary is granted to that employee if that employee fails to complete his or her studies for reasons other than death, ill health, and injury.
Okay, so let's read the part relevant for this question. Like, you don't have to read the whole thing. I'm trying to find it here, but can you repeat the first part that you read?
So any bona fide scholarship.
Yes.
So it's basically any bona fide scholarship or bursary other than that contemplated in section Q cap A. If the bursary has been granted by an employer to an employee or a relative of such an employee.
Okay. Where are you reading? Which subsection?
This is 10.1 Q Roman figure. Okay, Q, and then I went to Roman figure 1. If there's, do you want the remuneration proxy part?
Yeah, can you guys see my screen? Can you see the Income Tax Act that I've opened?
No, not yet.
Okay. Just confirm if you can see my screen. The Income Tax Act. Or would you like me to?
Yes, we can.
All right. Yeah. So basically, in the case of a scholarship or bursary granted to enable any such relative of an employee to to study, if the remuneration proxy derived by the employee in relation to the year of assessment exceeded 600,000 rand. So this one's remuneration proxy did not exceed 600,000 rand. Let's see. Okay, so much of any scholarship or bursary contemplated in this subparagraph, as in the case of any such relative during the year of assessment exceeds. So if it's such a long exemption, right? But basically, I just wanted to show it to you guys that you have to look at the remuneration proxy, the NQF levels as well. But in this case, we're not going to look at the NQF levels because the student was still in grade 12. So the value of the bursary was 30,000 Rand, and we are trying to establish how much the exemption is in terms of section 10.1Q. So perhaps let me just check. Let me go back to the question. Perhaps there's like a summarized version of the thingy in the text tables. Because I don't want you guys to just cram that we are always going to deduct a certain amount. I want you guys to be able to figure out how you get there, how you get to that exemption. Okay, can you guys see my screen? The question. I'm back to the question now.
No, we can't.
Let me know when you can see it.
Yep, we can see it.
Yeah. So yeah, there's actually like a summary of section 10(1)(q) in your annexes at the end of the question. So this is where I'm at, and it provides the amount for like the exemption amount for the scholarship or bursary. So annual ceiling. So, okay, so there's annual ceiling for employees, but this amount, this bursary was not granted to the employee, right? And then there's annual ceiling for employees' relatives, and then there's an annual ceiling for employee relatives with a disability. So, okay, so this is where we are going to look, because this child did not have a disability. So the annual ceiling is 60,000 Rand and 20,000 because there was no disability. Can you read paragraph 2BB of 10(1)(q)? Are you there, Samke?
I'm still looking for it. Mm. Wait, it's still paragraph 1, right? It's still 10(1) 2BB.
Okay. Right, I found it. Can you guys see?
Okay.
Okay, let me just share again. Can you guys see it? Yeah. So this is paragraph, this is section 10(1). It's 10(1)(q) BB.
Right.
Yeah, so it says to so much of any scholarship or bursary contemplated in
Alright.
this paragraph as in the case of any such member of the family of that employee. So yes, it's for the member of the family of the employee during the year of assessment exceeds, all right, a 30,000 Rand in respect of grade R to grade 12. And then a qualification which an NQF level of up to 1 to 4 has been allocated. And then 90,000 Rand in respect of a qualification to which an NQF level 5 to 10 has been allocated. So I think this is where these amounts are coming from in the table. So the bursary was like what I'm trying to establish is the bursary was 30,000 Rand. So the monetary thresholds are 60,000 Rand and 20,000 Rand, right? So I'll have to go back to the section and like read it properly. But yeah, I just wanted to show you guys where the exemptions are coming from. And so basically the bursary would go into the income of the of the taxpayer, and then there would be an exemption in terms of section 10(1)(q). The exemption is dependent on the grade of the student, grade arts at grade 12, and then the NQF levels. That determines the, those factors determine the amount of the exemption. Okay, so there would be exemption in terms of your memorandum. It's 20,000 rand of the bursary. So that means the 30,000 rand goes into the gross income, and then there's an exemption of 20,000 rand. So what I want to understand is, why are we not, taking out the full 30,000 rand? Because I'm looking at these thresholds of 60 and 20. However, I'll have to go back to the section and like read it properly. So yeah. So are you guys comfortable there? Would you be able to remember how to deal with a bursary? Are you guys there?
Sorry, Matima, I hate asking this, but like, just to confirm what you're saying, right? Or like, I'm looking at the section as well. Doesn't this mean that the 60,000 is the remuneration of the employee, what is it, remuneration proxy, right? So doesn't it mean like, if the remuneration proxy of the employee is more than, oh, this is 60,000, oh, hectic. Okay, no, it's fine.
Or you were trying to establish whether the 60,000 rand is the remuneration proxy.
Yes.
But this guy gets how much every single month? Wait, you could be right. Can I just check something? I want to check the amounts that constitute remuneration, or whether we are given his remuneration for the purposes of this question. We are given a remuneration proxy of 575, and when you divide that by 12, that's not more than 60,000. I don't know. I'll have to like go back. I haven't done this section 10(1)(q) in a very long time, so I would have to go back to it. So guys, please go back to section 10(1)(q) and just have a look at it. But yeah, that's your point of reference for scholarships and bursaries. You look at the remuneration proxy, you look at the scholarship. You look at the NQF levels and the grade and all of that. I feel like if I go through it right now, I'm gonna waste time. So perhaps if there's someone who feels like they still want to go over it after the session, we can discuss it after the session. We can go through it together after the session. Okay. So can we move on now?
Yeah.
Yeah. So okay, cool. So next up, we are focusing on the variable remuneration, and there was a bursary, and then there was also a lump sum, right? But when you read this lump sum, they're saying, let's see, this is the same lump sum that the employer was not aware of. So we're going to answer it on part it's the last question. Yeah, that's the last question. So for now, we only have the bursary. We're going to calculate tax on the bursary. And so we have 30,000 rand less the exemption of 20,000 rand. And so remember, our starting point of the calculation was the annual equivalent. So you add that to the annual equivalent, and then you calculate tax using your tables. You take out your primary and secondary rebate, like the same primary and secondary rebates you did for the first part of the calculation, and then you find your you deduct the employee's tax on the annual equivalent in the first calculation that you did, and then that's the tax on the bursary. And yeah, so I'll just, if you guys don't have the memo, I saw it in your group, but if you search for it in the group and you still can't find it, just let me know and I'll just forward it to you. Okay.
Okay.
So yeah, that's it for employees tax. Are there any questions for employees tax? Are you guys happy with the principles?
I am.
Okay, cool. So that's it for this question. Let's see what the second question says. We are required to, all right, based on the information provided in the question, calculate Sonke's second provisional tax payment. So we have to calculate the second provisional tax payment using his actual taxable income as his estimated taxable income. And for the purposes of answering this part of this question, assume the following. Number one, Sonke's remuneration for the purposes of calculating the remuneration, I mean the retirement contribution deduction is 650,000 Rand. So, okay, we have remuneration for the purposes of Section 11F deduction. Then we are given employees tax for the 2021 year of assessment, and then we're also given the first provisional tax payment of 2,000 Rand. Okay, cool. So let's go read. So we're going to use the same set of information. Yeah, but this time around, it's provisional tax. So we are calculating for, like, we're not going to divide by 12 and all of that. So first of all, we've got a salary, and that goes into his gross income. That's gross income. Then we've got the bursary. It was 30,000 Rand. Remember, we're not going to multiply it by 12 because it was only received once. So we've got the 30,000 Rand and the 20,000 exemption. Can you guys give me a second? I just want to charge my laptop. Just a second.
Sure.
Sorry about that, guys. I'm back. So where were we? Right. So the salary will constitute gross income. Then we have a bursary, and we're not going to multiply it by 12 because it was only received once, right? And there's an exemption of 20,000 Rand. This is in terms of Section 10(1)(q). Then we have a travel allowance. The amount of the allowance was 60,000 Rand. And so basically the 60,000 Rand will go into gross income, right? It will constitute gross income. However, hold on. However, do you guys notice here that we don't do that 80-20 thing? That's for employees tax. Okay, guys?
Yeah.
Yeah, that's for employees tax. So we take the 60,000 rand. The 60,000 rand is the amount of the allowance that will constitute gross income. Then the logic behind this is now we have to reduce that allowance by the portion of business travel, okay? Because it doesn't make sense for me to receive to be taxed on business travel, right? So the taxpayer will only be taxed on the amount, on the portion that was expended for for private travel. So you take the allowance, you reduce the business portion, and then you'll be left with the private expenditure, or the private portion, and then that's the amount that the taxpayer will be taxed on, right? So when you calculate a travel allowance, let's just go read point number 2 again. It says that Sonke's employer paid him a travel allowance for using his own motor vehicle to travel for business purposes, and he always kept a valid and accurate logbook, and his employer is satisfied that he travels 80% for business purposes. During the 2021 year of assessment, he traveled 20,000 kilometers for business purposes out of a total of 24,000 kilometers, so which means that 4,000 was for private travels. And then his vehicle cost him 180,000 rand, including VAT. Sonke paid all the maintenance and fuel expenditures, but he did not keep an accurate record of his actual travel expenses. So for the purposes of this question, we have to establish, we don't have actual costs of fuel and all of that. So we then have to calculate the deemed costs. Okay, so very important. Sometimes sometimes you can be given the actual costs, right? And you would still have to go on and calculate the deemed costs using the table, using the travel allowance table. And the reason for calculating both of those costs, the deemed costs and the actual cost, is because you want the highest costs between the two, between the deemed cost and the highest cost. So what is the logic behind that? You remember, the highest amount means that you will be taxed on, okay, so you've got the allowance of 60,000, and I'm just giving you guys like, a logic to follow. So you've got 60,000 rand that has been included in your taxable income. And you have to reduce this amount by business travel, by business portion, to be left with the private portion. And to do that, you calculate, like here, we're only going to calculate the deemed cost because we don't have the actual cost. But if you get a question that gives you actual costs, you still have to calculate deemed cost and make a comparison of the two. And then you want the higher of the two, because the higher of the two means you are reducing your taxable income. You are reducing the allowance by a bigger portion. So that means you are taxed on less. I don't know if you guys kind of get where I'm going with this.
Yeah, I do.
Yeah. So, but here we don't have actual expenses. So we're going to calculate the deemed cost, and our starting point would be, let's see. So we have to go to the travel allowance table, and we are looking for the fixed cost. So let's just see if there's there should be a travel allowance table in here. Yeah, so this is employee owned vehicles. How much was that vehicle?
It was 180,000, but that was including that.
Yeah, so it was 180,000 rand. So that means this is the bracket that we're going to use. It exceeds 95,000 rand, but does not exceed 190,000 rand. So this is the fixed cost that we're going to use, right? And then you're going to take your fixed cost and you're going to divide it by the total kilometers. So we are calculating the deemed costs. So I'm just going to do like a small working there. The fixed costs. Um, 894 divided by the total kilometers. And how much do you get there? Can someone calculate it for me?
2.32 or 2.33.
Yeah, so you get 2.329. So I'm not going to round it off. And then we've got fuel cost. And that's 118.1. Agreed? So you divide that by 100 and how much do you get? Can you guys divide 118.1 by 100?
Mm, 1.181.
So you get 1.1, you say 181.
Yeah.
Okay. And then you do the same with the maintenance.
Yeah, that's going to be 0.468.
468. 0.468, 0.468. And then you add that up.
You are left with 3.978.
You get 3.978, right? So you've calculated your deemed costs, right? And then now the next step is to calculate, to multiply this answer that you got here by the business portion. Because remember, we are trying to tax this person on the private portion. We have included 60,000 Rand in taxable income. Now we are trying to reduce the business portion. And the business kilometers were 20,000 kilometers. So we multiply by this, by the 3,987. How much are you guys getting?
I got 79,558.33.
Correct. So that's the amount that we get to reduce the 60,000 by, but obviously it has to be limited to the actual allowance, which is 60,000. So that means from the travel allowance, we will then deduct 60,000 Rand, even though the total cost, the total deemed cost is 79,560. So we limit it to the actual allowance, which was 60,000 Rand. So at the end of the day, this taxpayer will not be taxed on the travel allowance because there was 60,000 Rand less the business portion, then there's nothing left. Are you guys following?
Yeah.
Yeah. So that's how you deal with the travel allowance. Is everyone happy?
Yeah.
Yeah. So let's go back to the question. So we've got so we've dealt with the travel allowance, then there's retirement annuity fund lump sum benefit. So when it comes to these funds, okay, so these lump sums you can either get a lump sum from an employer or you can get a lump sum from a fund. Okay, so guys, just make a little summary of that because sometimes you may not know which table to use, right? So, but this, we're going to do a separate calculation on it. The retirement annuity lump sum fund, we're going to do like a separate calculation on it, but you need to know which table to use. So a lump sum can either be from your employer, and that would be a severance benefit or just a general lump sum, right? And then a lump sum from a fund would be either a withdrawal or retirement, or a retirement lump sum. Okay, so when the question tells you the lump sum is from an employer, you're most likely going to, it's either a severance benefit or just a general a general lump sum that will be included in gross income in terms of paragraph D of the gross income definition. But when they tell you the lump sum was from a fund, then it's either a retirement lump sum, so that means you'd use the retirement table, or a withdrawal. Okay, so I just wanted you guys to be aware of that. So we're going to do a separate calculation there. Then there's retirement annuity fund contributions. Now we're dealing with normal tax. We're not dealing with employees tax, so it's irrelevant whether or not the employer is aware. It's irrelevant for normal tax purposes. So the total contributions were 100,000 Rand. Very important. Sometimes the question will tell you that the employer has been making contributions on behalf of the taxpayer. How do we then deal with that? Anyone?
You would add their contribution and your contribution when you're doing the calculation.
Excuse me, please repeat that.
You would add your contribution and the employer's contribution
to get the deduction, right?
Yeah.
But the actual contribution that the employer makes on your behalf, on the taxpayer's behalf, would constitute a fringe benefit, and it would go into gross income. So before we even talk about that deduction that you're talking about, there's a fringe benefit of the employer's portion. Okay. Yeah. So in this case, we're not told that the employer has contributed anything, so there's no fringe benefit, but we just go straight to the deduction. And is there anyone that wants to take us through the deduction? Section 11F deduction.
Okay, so we would take the 100,000 that the employee has. So we have that amount, and then we need to calculate the higher of the taxable income that we have times 25%, and then the higher of the remuneration, which I think they give us at the requirements.
Yeah.
At the bottom of the question.
Let's see. That's 650. Yeah.
Yeah. So you times that also by 25%, and then you get the higher of that.
Yeah, it's 27.5%, right?
Yeah.
Yeah. So that's how you calculate your deduction. So then our deduction would be, let's see, our deduction would be, it would be the full amount. Yeah, it would be the full amount of 100,000 Rand, because 650 times 27.5% is like 178,000 Rand. And yeah, and then there's 350. So the full amount of 100,000 Rand would be deductible in terms of section 11F. So guys, that section 11F calculation is very important. Like, you have to write out the 350, the 27.5% of 650. Like, don't just punch it in your calculator and not show the actual working, because there's a mark for showing the actual working. Okay. So yeah. So that's just about it. Then we've got taxable income. You calculate your taxable income, you calculate your normal tax per tables, and then there's the rebate. Remember, our taxpayer is 65 years old, so our taxpayer will get both the primary rebate and the secondary rebate. So that will be 14,958 plus 8,199. So you get your total rebate. Then there's the medical scheme fees. So again, For normal tax purposes, it's irrelevant whether or not the employer knows that the taxpayer has been paying medical aid. It's irrelevant for normal tax, but it is relevant for employees tax. So now we're calculating we're calculating provisional tax. Wait a minute. Yeah, we're calculating the second provisional tax payment. Yeah. So is there anyone that wants to take us through the section 6A, section 6B? This will definitely be there in your exam, and there's a lot of marks there. So you guys have to be very comfortable with it by the end of today, because you guys are writing tomorrow.
Yeah. Okay, I'll give it a try.
Okay.
Just quick one question. How many people's on the medical aid? I don't have the question with me.
Okay, let's see.
It's just him.
Let's just double check. Yeah, looks like it's just him because, wait, it's question 3. They say that he is a widower. Yeah, so it's just him.
And he's not disabled.
He's not disabled, but he's 65.
Okay, 65. Okay, so for section 6A, you're going to have one dependent, and then the rate per month is 319. So you'll take 319 times the one dependent times 12 months, and then you are left with 3,828. So that's going to be your section 6A rebate.
Correct.
Correct?
Yeah.
Okay. And then section 6B, our contributions are, I can't see the question.
Okay, let me just scroll up.
48,000.
48,000.
Yeah. A contribution of 48,000. And then we have to subtract the section 6A times 3 because it's above 65. And then we're left with 11,484.
Yeah.
Subtracted from the contribution, we have 56,516. Do we have additional expenses?
Yes, we do. He paid an extra 3,000 Rand for prescription glasses.
Okay, so we're adding the 3,000. Then we're left with 39,516. And because he's above 65, we times that by 33.3%. And then we're left with 13,158 Rand 83 cents.
Yeah. So that's the section 6B tax credit. So you take that out, and then let's establish whether there was any prepaid taxes. Let's see. Okay, so Sonke is a provisional taxpayer. The following information is available. Okay, so this is okay. Let's see what we have. We have employees tax of 140,000 Rand. We're gonna take that out. And then the question also gave us the first provisional tax payment. Then we also take out the first provisional tax payment, and that's it. Remember, this question was not, even though it felt like a normal tax liability question, it was asking for second provisional tax payment, and they gave us everything we need for the second provisional tax payment. So I think this was quite a straightforward one. Is there anyone that needs more clarity here?
Just one question. If, for example, they had you had to calculate your tax on your lump sum, would you add the lump sum after the prepaid taxes or before the prepaid taxes?
I think you would wait, just hold on.
Just in terms of the layout, because it doesn't matter where you do it. I mean, it's still going to add up to the same.
Yeah, I think, well, I think you do your normal tax calculation, and when you're done with everything, then you do your lump sum calculation.
Okay.
Yeah.
Sorry, can you please just repeat for me what you said happens when the lump sum is from a fund and not an employer?
Oh, okay. So I said a lump sum can, like, because sometimes you just get, when it comes to retirement funds and all of that, sometimes you just get so much so much information in the question, and you may end up not knowing which tax table to use for the lump sum, right? So I was saying that a lump sum can either come from an employer or from a fund. So when it comes from the employer, it's either like a general lump sum, which will be included in gross income in terms of paragraph D of the gross income definition, or it's a severance benefit. Okay, so that means that if the question tells you it's a severance benefit, then you would use the severance benefit tax table for that lump sum. But if it comes from a fund, it can either be a withdrawal or a retirement lump sum, and then yeah, that should guide you as to which tax table to use.
Okay, thank you.
Yeah. Any other question before we move on to the next two questions? All right, let's move on. So part C, if Sonke did not use his actual taxable income as under the required of part B, advise him how to determine the basic amount for the purposes of the second provisional tax payment, and support your advice with a clear calculation of the basic amount, and provide reasons why you would use or provide reasons why you used or did not use specific amounts. So this has to do with the basic amount. Let's see if we have information that we can use here. So the following information is available: the date on which his taxable income, the assessment for the 2019 year of assessment, let's see. This assessment was issued on the 31st of December 2020. And then the taxable income indicated on this assessment amounted to 580,000 Rand. And then it was further indicated that Sonke incurred an assessed capital loss of 10,000 Rand. Then the date on which his income tax assessment for the 2020 year of assessment was issued, it was issued on the 18th of February 2021. And the taxable income indicated on this assessment amounted to 620,000 Rand, which included an amount of 15,000 which relates to a taxable capital gain. So is there anyone that has an idea of how they would go about this one? Let's start. Okay, I know the question is saying basic amount, and it's asking in the context of the second provisional tax payment, but how do we determine? Let's start with the basic amount in the context of first provisional tax payment. How do we determine that? Anyone?
Don't we use like the latest preceding year of assessments issued estimate that is not 14 days older, that is 14 days older than the basically the first provisional team. Oh my god.
No, you're right. Go on, go on.
Yes, it's just that the words are not coming out now of my mouth. Yes. Of the first estimate.
Yeah. So you are right. You look for the latest, the latest preceding assessment, and this assessment must be older than 14 days. So if it's not older than 14 days, then you can't use it, right? So, okay, that's okay. Just hold on. I just want to read the question properly. Right. So the same principle applies with determining the amount for the second provisional tax payment. So your biggest takeaway from provisional tax should be, I'm trying to add a comment here and okay, I'll just add a text. Your date, right? So your first provisional tax payment, no, this is not neat. Yeah, this is what I'm trying to do. I'm trying to add a comment, yeah. So your biggest takeaway from this provisional tax payment should be knowing your date. I can't stress this enough. You have to know your dates when it comes to provisional tax, right? And for your first provisional tax payment, when is it due? It is due on the 31st of August, 2020. And I use 2020 because if we are dealing with a natural person, then his year of assessment ends on the 28th of February 2021. So this is when the first provisional tax payment would be due. And then the second provisional tax payment would be due 28 Feb 2021. So when you're looking for that assessment, for the first provisional tax payment, it has to be an assessment before 31 August 2020. And it has to be like the latest assessment before 31 August 2020, and it must not be less than 14 days. So it can't be issued, less than 14 days. And then when you're looking for, and then in the context of a second provisional tax payment, also the same principle will apply. You look for an assessment before the 28th of February 2021, and it must not be less than 14 days. So back to the question, because we know that the second provisional tax payment is due on the 28th of February 2021, we have two assessments, right? And the latest one is the one that was issued on the 18th of February 2021. That's the latest one. And it was 620, right? However, when we look at the 620 and we look at the date, we have to calculate the number of days between 18 February 2021 and 28 February 2021. And if you calculate these days, this is about 10 days or so. It's about 10 days or so, right? So this assessment was not older than 14 days. Yes, it is the latest assessment. It's the most recent assessment for the, for the second provisional tax payment. Yes, it's the most recent, but it was issued 10 days ago. It has to be older than 14 days. So therefore, we can't use the 620,000 Rand for the purposes of calculating our second, for the purposes of calculating our basic amount. So that means then we move on to the 580,000 Rand. So that's the one that we're going to have to use because it's more than 14 days. It's been issued more than 14 days ago. So are you guys understanding what's happening here?
Yes.
So for the purposes of your provisional tax calculation, your assessed losses are not allowed as a deduction. But if you had a capital gain, if it was a taxable capital gain, you would take that out, okay? But it's not a taxable capital gain, so you don't take that out. So that means our basic amount will remain 580,000 Rand. And remember, the thing with the principle when it comes to the basic amount, if the basic amount is older than, if the gap between the date of assessment and, let me just make a note because, yeah. So if this date, 1 December 2020, and your second provisional tax payment is due 28 Feb 2021. So if the gap between these months is more than 18 months, then you adjust your basic amount by 8% annually. Are you guys comfortable with that principle?
Yeah.
Yes.
Yeah. So let's count the number of months. Let's establish whether or not we need to adjust our basic amount. Let's count.
So It's December 2020, Jan 2021, and Feb 2021. So that's only 3 months.
So that's only, no, sorry, I made a mistake. I just want to check something. Yeah, no, you are right. It's just 3 months, right? So you have 580,000 Rand. We don't have to adjust it because it's just 3 months. Okay, so yeah, so that's it for the basic amount. I think it was more of a theory question with a bit of calculations, but the biggest thing is you have to be able to, you know, state why you're going to use a certain amount as the basic amount. Like you have to be able to like put it into words and substantiate why you're using the 580 and not the 620. Okay.
Yeah.
Yeah, so that's it for part C. And then part D, calculate normal tax liability on Songe's lump sum benefits. So let's see. So this one was quite a straightforward one. The lump sum received was 1.6 million Rand, and we just have to find the retirement. First of all, you have to be able to identify the correct table. Is this a severance benefit? Is this a withdrawal? Is this a retirement lump sum? So you have to be able to identify that in a question. So it's a lump sum. So it's a retirement lump sum. So you're going to use your retirement table. Let's just find it in the question. So the amount was
1.6 million.
It was 1.6 million. So we're going to use the last amount in the text table. So yeah, so that will be 130,500 plus 36% of taxable income exceeding 1,050,000 yeah, so that's how you're going to calculate the tax on that, and it's as easy as that. Okay, so that's it for that question, guys. I think we can now move on to the last question, question 4. Is there anyone that has a question on question 3?
No.
Okay.
No, I'm good. I'm good.
All right. So part A, okay, so question 4, there's trusts, and that's part A, and then part B, there's estate duty. All right, so are you comfortable with trusts? Would you like us to like go through both of these questions, or do you want to perhaps attempt it and send it to me during the day?
Can we just go through the last question?
All right. So, okay, so David died on the 1st of February 2021. I'm just going to highlight that. At the age of 78, all right? So he was diagnosed with a terminal illness in November 2020. He is survived by his wife, Delia, who's 69 years old, and a son, Jason, who is 49 years old. Sean is David's sole heir in terms of their in terms of his valid testament. Okay. So you're required to calculate the net value of David's estate for estate duty purposes. So that's out of 5 marks. So the question goes on to say that the executor of David's estate found the following. Number one, there was a farm. The farm bread and butter on which bona fide farming activities are conducted at a fair market value of 12 million rand. So do you have any idea how we go about this one?
No clue.
Okay, so you would include the market value in the calculation of the net estate, right? However, when the property is relating to farming activities, you're going to reduce that amount by 30%. So this is only for farming, like when they tell you that the property was used for farming activities, you include the market value, but you included less 30%. So you can either include the 12 million in the calculation and then take out 30%, or you can just say 12 million times 70%. At the end of the day, only 70% will go into the calculation for estate duty purposes when they tell you that the farm or the property was used for farming activities, okay?
Okay.
Then number two, David owned 100% of the shares in DJ Pty Ltd. The company took out a domestic life insurance policy on David's life, and the policy paid out 1 million rand due to David's death. Okay. And so, okay, all right. So, okay. And then the value of the shares was enhanced by 500,000 Rand on David's shares because of the policy. And then there's an independent valuation of these shares. Okay. So the first thing here is we've got the actual policy, number one, that was paid out. There's a policy paid out as a result of death. And then number two, the shares that this guy owned worth 1.5 million. However, these shares got increased by 500,000 Rand after he died. So yeah. So there's two things happening there. So the actual policy, when the question tells you that there was a policy paid out as a result of the taxpayer's death, you include the you include the amount in the value of the net estate of the taxpayer. So yeah, so you're going to include the 1 million rand. And then secondly, there's the independent valuation of the shares. So the shares were valued at 1.7 million rand. However, they only increased by 500,000 rand because of the policy, like as a result of his death. So we want the actual market value of these shares at the date of death, and that would be the 1.7 less the 500,000 rand. So only 1.2 million would be included in the calculation of the net value of the estate. And then lastly, we've got proceeds of domestic policy taken out on David's life by Jason. Okay, so Jason paid all of the premiums and interest compounded at 6% on the policy amounting to 700,000 Rand. And Jason was the only beneficiary according to the policy stipulations. So you've got an amount. So, okay, so we've got an amount of 2 million, and this is proceeds of domestic policy taken out on David's life. And then you have to reduce it by the amount that Jason paid. And the amount that Jason paid was 700,000 Rand. So at the end of the day, only 1.3 million Rand will go into the calculation of the net value of the estate. So yeah, that's how you go about it. I think very important for estate duty, you have to know what goes into the calculation, what goes into the calculation, and also what constitutes a deductible expense for estate duty purposes, because sometimes they'll also throw in deductions there. So not all of the deductions are deductible for estate duty purposes. So my advice would be just, make a little summary somewhere that you can, easily remember for your exam. So just summarize the amounts that are deductible for estate duty purposes and the amounts that will be included and the amounts that will not be included. And then when they tell you that a property was used to carry out farming activities, the market value will be included. However, it will be included less 30%. So yeah, so that's just about it for this question. Do you have any questions?
No, I'm good, thanks.
All right. So a lot of people have texted me that they are struggling with load shedding. So I think it's just the two of you guys. Yeah, it's just the two of you guys. Everyone else is complaining about load shedding. But that's it for today, guys. All the best for your examination tomorrow.
Thank you very much. Appreciate you letting me join.
All right, no problem. Bye.
All right, thank you so much.
All right.